supply side and the demand side and the deficit. Okay, we've got a deficit. So what we've got to do is we've got to pencil in a number somewhere which will cover it. So you can see that to some extent the number is made up. But I mean, after 4 years, and not only that, but I mean, in this country we've got lunatics in government who are trying to carpet the country with solar cells. This demand is not going to go away. And one of the other things, actually, going back to COMEX deliveries on the silver side, is that the Indian government decided, it needed to do something nice and, ESG friendly, whatever. Stop criticism from G20 fellow members. So they said, right, okay, what we'll do is we will subsidize the production of photovoltaic cells.
The Silver Institute reports a continued supply-demand deficit in the silver market, driven by government initiatives like India's photovoltaic subsidies and the UK's solar panel push. For the 5th year, demand has outpaced supply, raising silver prices. Industrial uses, led by green energy, AI, and EVs, now represent 64% of global silver demand. Alasdair Macleod, a renowned economist, market strategist, and expert in precious metals, says that market commentators often misunderstand the relationship between gold and yields, mistakenly believing higher yields make gold less attractive due to its low or zero yield. In reality, gold is a hedge against declining fiat currency purchasing power, particularly the US dollar. Historically, interest rates were used to stabilize currencies under a gold standard, not to manage economic outcomes. Alasdair explains that modern central banks have repeatedly created credit bubbles by lowering interest rates to protect markets and weak investments, leading to the largest bubble in history. When this bubble bursts, central banks will have limited options, as further rate cuts risk collapsing currencies. The safest move is to exit credit and turn to real money, gold and, to a lesser extent, silver. Here are key insights from Alasdair's recent interview. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
Market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so all central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been a credit bubble, the response from central banks has been to reduce interest rates sharply, to take the pressure off malinvestments, off the zombies, if you like, off banks which may be over-leveraged for those conditions and face substantial loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as, you read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. This is twice as big. I mean, when this bursts, it is going. I mean, there is nothing, absolutely nothing, any central bank can do about it, because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
Alasdair recalls that in late 2020, gold prices surged to new highs, driven by a crisis in exchange for physical EFP markets exacerbated by COVID-19 disruptions. HSBC reportedly incurred over $200 million in losses related to EFP, highlighting the seriousness of these markets. The COMEX, traditionally not a delivery-focused market, saw unprecedented demand for physical gold as many began taking delivery instead of closing futures positions. This shift reflects a bid-only market for physical gold, with refiners and vaults facing immense pressure to meet demand. Liquidity in Western markets, including the London Bullion Market Association, has significantly declined, with much of the demand driven by Asia. Meanwhile, the drying liquidity and growing strain in gold markets signal the potential for a significant price increase, supported by global macroeconomic fundamentals. Central banks, concerned about debt and currency stability, are shifting away from currency reserves and credit, favoring gold as a more stable store of value. This trend underscores a growing demand for physical gold as a hedge against financial instability and devaluation of fiat currencies. Now, let's dive into the interview.
Late 2020, when gold first ran up to challenge new highs, 2070, something like that, there was a crisis in the exchange for physical. And, deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out because for every long there's a short. Okay, so it closes out. Or alternatively, you can take delivery. But because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone taking delivery now? Well, not everyone, but I mean, you can see that there are huge, huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of futures. So it's a bid-only market in effect for physical, and the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. If you go to start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff. This is more than most countries' gold reserves. since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contract so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary, extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold. But that has to be justified. It has to be justified by the fundamentals. And here we come back to the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit.
The ongoing shifts in gold and silver markets underscore a broader reevaluation of monetary stability and the role of physical assets. As central banks and governments prioritize gold and silver to mitigate the risks of credit bubbles and currency instability, these metals are increasingly viewed as essential hedges against financial and economic uncertainty. This trend highlights the critical interplay between market fundamentals, policy decisions, and investor sentiment in shaping the future of precious metals. How might sustained demand for silver in photovoltaic production impact long-term supply dynamics? What strategies can investors adopt to protect their portfolios as central banks face limitations in addressing future credit bubbles? Feel free to share your thoughts in the comments below. Don't forget to like this video, subscribe to the channel, and turn on notifications so you don't miss out on future updates. Thanks for watching, and we'll see you in the following video.